What is up, guys and girls, and welcome to DecDoesInvesting, the wealth, investing and finance channel. Before we start, I'd like to ask you to hit the subscribe button to join me on my journey, and also hit the like button to help me out with the YouTube algorithm. In today's video, I have episode 21 of my dividend investing journey, and since the last time I updated you guys, I've added another £500 capital to the portfolio and made one new investment. That investment being in the Gym Group, in which I have purchased 332 shares for an average price per share of £1.50. With the success of last week's episode, I'm now going to structure these portfolio updates as such, starting with my biggest gainers and fallers, along with any notable news that I can find. Then moving on to my new investment, along with the analysis and fundamentals. Then finally wrapping up with how the portfolio has changed over the last week in comparison to last week's episode. So in this week's update, there hasn't been any major fallers to report on once again, as both the UK and the US market has risen quite nicely on the back of lockdown measures being eased and the current market momentum. However, one stock that hasn't performed well for me and is my biggest faller is Hsbc, which has seen a 3.65% fall despite the markets going up. Now, from what I've managed to find, this is down to tensions between China and Hong Kong. An article I found from Proactive Investors headlines Hsbc and Standard Chartered sink as China plans to impose new security laws on Hong Kong. The article starts with Hsbc Holdings and Standard Chartered plc saw their shares sink on Friday following fresh moves by the Chinese government to rewrite Hong Kong's legal code, sparking fresh fears of protest and erosion of independence of the financial hub. Shares in Hsbc fell 4.2% in late morning trading, while Standard Chartered slipped 1.9%. Both banks have significant operations in Asia and derive a large portion of their profits from the region. The article then continues with recent events place Hsbc in a particularly tricky position, with the bank having previously considered moving its headquarters to Hong Kong from London. Pressures to relocate increased in April after Hsbc suspended dividend payments under pressure from the Bank of England, attracting the ire of Hong Kong retail investors. Finally, to wrap this article up, it states, at the time of already strained relations between China and the West, this decision will only isolate Beijing even more. Investors will need to add renewed Hong Kong-Beijing tensions into their mix of geopolitical risks, whilst the way it fits into the broader US-China rivalry will be closely watched. An additional risk from the US is the designation of Hong Kong as a distinct trading jurisdiction compared to mainland China, which grants it special trade privileges that are not available to the rest of the country. If the US government decides to revoke these privileges, Hong Kong's economy, which is already suffering its steepest recession since records began in 1974 following last year's protests and the pandemic, could find itself in even more jeopardy. So my take on this article as a Hsbc investor is a concerning one, and a situation that I feel is going to loom over the company for a while. As the article states, despite Hsbc being a UK company, a large portion of their profit comes from Asia, and with this potentially being in jeopardy due to sanctions and other political agendas, then their share price is at serious risk. I think what makes this worse is that a lot of this is out of the control and the hands of the company itself. Another article I found from Business Leader headlines Hsbc increased job cuts to more than 35,000 to save $3.65 billion in costs. It goes on to say that Hsbc's US and European businesses and investment bank have been badly affected by the impact of the outbreak and subsequent lockdown. The bank's Asian operation has not been badly affected, and the plan is to retreat its operations back to its historical homeland in the Far East. The pandemic could leave Hsbc with debts of up to $9 billion due to bad loans this year alone. This has led to Hsbc executive looking into making further cuts, which could be announced as early as next week. Now, this article states that the pandemic could leave Hsbc with debts of up to $9 billion, which has forced them to cut jobs in order to save costs. It's never good to see a company forced into cutting jobs to save costs. However, with the financial sector always being one of the worst hit in a market downturn, this hasn't really come as a surprise to me that jobs are being lost, especially with the unemployment numbers coming out of the US. What's interesting is that it states its Asian operation hasn't been badly affected. However, with the previous article I just covered, could this now be under jeopardy? My honest view and opinion is that if I was in the green with Hsbc, I would sell and take my capital elsewhere. The uncertainty not only of the company but also the sector doesn't fill me with confidence. However, it's one I'm just going to have to ride out and see how it plays, as I'm not one to sell for a considerable loss. Now moving on to my gainers, and there's been a few to say the least. The majority of these have been from my UK investments. with the Gym Group boasting a 37.1% return, Virgin Money boasting a 27.64% return, and Aviva and Greggs boasting a 10.51% and a 9.91% respectively. This is mainly down to Boris Johnson easing lockdown measures and the UK moving into phase 2. An article from This Is Money states the FTSE 100 closed 1.2% higher, whilst the FTSE 250 closed 3.25% higher, with the announcement that UK retailers can open from the 15th of June. Another article reads other sectors such as hairdressers, hotels, pubs and cafes, etc. will be open from the 4th of July at the earliest, which again gave not only me but other investors the confidence that the economy will get back up and running in the near future. Another stock that rose nicely this week that I want to touch on is AT&T, which grew 6.99%. Now, not only do I think this stock has risen in accordance to the market going up, but I also feel this is down to its release of Hbo Max. An article from CNN Business states that Hbo Max, it's a streaming service that has programming from three main sources: the company's premium cable network, HBO, the company's nearly 100-year-old film and television studio, Warner Brothers, and cable channels including TNT, TBS, Cartoon Network, True TV, and Turner Classic Movies. The service costs $14.99 a month. At this price point, HBO Max costs twice as much as Disney Plus, and more than Netflix standard plan, which costs $12.99 a month. So what will HBO Max subscribers get for $15 a month? About 10,000 hours of programming. That's less than most of its competitors. But it has a large number of compelling offers, including blockbusters like The Joker, The Matrix, the Lord of the Rings series, as well as classics like The Wizard of Oz, When Harry Met Sally, and Casablanca. Most notably, the service will be the home of Friends, one of the most popular sitcoms in TV history. The service will also have new series called Max Originals, beloved shows like The Big Bang Theory, The Fresh Prince of Bel-Air, South Park and Gossip Girl, and children's programming from Looney Tunes, Cartoon Network and Sesame Street. Obviously, HBO series, both new and old, will be a major part of the service, which will include Game of Thrones, Westworld, Sex and the City, and Succession. As for HBO Max movie lineup, the streaming service will be home to more than 2,000 films within its first year. My view on this article and the release of HBO Max has me on the fence of whether it's going to be a success or not. It has the potential, in my opinion, to be one of the best streaming platforms with some fantastic titles. However, what concerns me is not only the content, or should I say lack of it, but also its price point. With a lot of people already having streaming subscriptions, could people justify the extra $15 a month for HBO Max? Or if it came between a toss-up, would people go for HBO Max over the likes of Netflix, which has a considerably more content? What I hope is that this doesn't become a cash cow and doesn't become a viable or profitable platform for AT&T. So that wraps up the news segment of the episode, and I will now go into the reasonings and analysis of why I purchased the Gym Group. The Gym Group has a pretty cool ticker symbol, GYM, and is listed on the London Stock Exchange. The Gym Group, if the name doesn't give it away, are a gym chain that offer high-spec gyms at affordable prices. Now, this has been a stock that I've had on my watch list for a while now, and a company I have once been a member of myself. The company is one of the few companies that has got me excited for the future coming out of the UK. It's won a number of awards, such as coming 13th in the Sunday Times Fast Track 100, and also placed 15th in the prestigious The Sunday Times 100 Best Small Companies to Work For. If we take a look at the one-year chart of the Gym Group, we can see that back in January it had its 52-week high of £3.16, and back in February it was just shy of this figure again before the market saw its crash. Like I've said previously, I managed to pick up my shares for a price of £1.50, which gave me a discount of around 53% off its 52-week high, which was an absolute steal in my opinion. Taking a look at shareholder returns, we can see that the Gym Group has been publicly traded for less than 5 years, and therefore we must use the 3-year period as our metric. Over this time period, we can see that it's had a negative return of 28.4%, which is somewhat in line with its industry, which saw a negative return of 27.5%, but much lower than the market, which had a negative return of 7.9%. Now, I don't really like to invest in companies that have had a negative return to shareholders, as the name of the game as a shareholder is to see returns on your capital. However, with the vision and the growth of this company combined with my entry price, I'm very confident that this was a great buy, and in my opinion, a stock that I could see myself 2xing my money on. Simply Wall Street and its analysts currently undervalue the Gym Group by 46.5% in comparison to its fair value of £2.55, which means there is a fantastic discount to be had right now, like I've said already, and one I wish I got on earlier than I did. If we now look at the Gym Group's forecasted annual earnings growth, it is a whopping 50.6%. We can see that this beats the industry of 35.7%, and over double that of the market of 20.1%. This is also reflected in its forecasted annual revenue growth, which is expected to grow 13%, which is double than that of its industry average, and also just under 4 times that of the market. These were the numbers that really attracted me to the Gym Group, and as a growth stock play, this really does have the momentum to turn out some real good numbers in the future, which is further supported with this graph of its earnings and its revenue. It became profitable back in 2016 and has managed to maintain it, which is really important for growth stocks. It has also done this whilst churning out a revenue growth which eventually should see its profits rise as well. Looking at the Gym Group's past growth analysis, we can see that over the past 5 years it grew 57.3%, which totally outperformed its industry and also the market, which saw returns of 10.3% and 13% respectively. However, over the past year, the Gym Group has struggled and its earnings decreased by 27%, in a time where its industry also struggled, however only decreased 10.9%, and this figure is considerably much lower than the market, which grew its earnings by 2.8%. Moving on to the Gym Group's financial health, we can see that it doesn't cover its short-term liabilities of £49.6 million, nor its long-term liabilities of £313.3 million. This is one of the things that marked the Gym Group down in my analysis, as its gyms are currently closed and they have frozen their memberships, meaning that their main source of income has now been taken away. However, I don't believe this pandemic will send the Gym Group under, and therefore I have weighed up the risk and I believe this is still a good investment. Now finally, the Gym Group has suspended its dividend, which is understandable considering what we're finding ourselves in. But back in 2019 it did pay a dividend of 1.3p per share, giving it a yield of around 0.5%. However, looking back at this graph, we can see that its dividend isn't stable, nor does it look like it's growing year on year, which is to be expected from a growth stock. I never purchased the Gym Group to be a staple dividend payer, and it was more for its growth potential, and any dividends I receive potentially in the future will be a bonus. That wraps up my portfolio update for this week. Unfortunately, once again, I haven't received any dividend payments. So to give you guys an overview, the portfolio is currently sitting 4.25% down, or 3.25% down if we account for the dividend income and currency gain. So this has been a fantastic week for the portfolio, which saw some huge gains from Virgin Money and the Gym Group, which has clawed back a big portion of our losses. As last week we were sitting at 8.92% loss, including currency gain and dividends. Fingers crossed this current positive momentum can continue and maybe the portfolio will break back into the green once again. So thanks for watching. If you've liked the video, please drop it a like, subscribe if you want to see more content like this, and if you've missed any previous updates, there will be a link to the playlist in the description down below, along with some other videos. And until next time, peace.